What's going on, everybody? Welcome back to another episode of the Playbook Small Carrier Market Update, where every week we break down the data that actually matters. If you're running one truck, five trucks, it don't matter. As long as you're trying to stay profitable, we're here to help. This isn't Wall Street. We're not here to impress anybody. We're just here to help small fleets make smarter decisions this week, not next quarter. So whether you're leased on, running your own fleet, dispatching for owner operators, this is your 5 to 10 minute check in on what's moving, what's stalling, and where the opportunities are. So, really want to dive into this week because got a lot of stuff to cover for you this week in this week's small carrier market update. There's been a lot of things going on, specifically around the 25th, where the ELP ruling has finally taken flight and enforcement is going to start to happen. So we're going to be watching those metrics as we go through the next carrier market updates as we move forward in the future. But in the meantime, let's talk about the good stuff. Outbound tender rejection. For the first time, we're seeing it trend upward. It's up 7.8% week over week. We're at 6.77%. If you look all the way to the right and you see how that's trending, we've had a significant increase in overall tender rejections. This is the highest level since early April, meaning that it seems like that contract capacity is starting to tighten. What that means for you is that contract when it comes down to the contract market, there are more contract freights that's being spilled over to the spot market. That's simply what it is. So keep an eye on that outbound tender rejection. The higher that goes, obviously you'll see more opportunities. I expect small carriers may see more spot opportunities, especially if it goes into July, past that 4th of July holiday. So it's something worth watching. Even though we're well below the COVID rejection levels of 30%, which is just a complete anomaly, like I said on our last small carrier market update, anytime we start hovering up around that 9-10%, it's a pretty fair game. I think it's something that is worth watching. So, one of the things that I also would say that could be a possible driver, it could be those seasonal surges. And those seasonal surges are driven obviously by holidays and things of that nature. But ultimately, I do want to give it a little bit of credit for what we're doing. And I do think that we're starting to see some things tighten up, especially with some of the data that I'm going to show you at the end of this slide today. So, really want to kind of talk about that. We see volume as a whole. Overall volume still down about 3.38%, which is one of the concerns that I have. You're going to have flat volume right now that's compared to week over week. In order for us to see better rates, we want to see better volume, but we also are starting to see those overall rejections spike up. So it's just a weird mix. And that's the thing that I wanted to really kind of look at is that we're still oversupplied. So we still have too many carriers in the fold, which we'll see about that here in a few minutes too. We're still oversupplied, but ultimately we are starting to see a little bit of headwinds that's saying that, hey, you know what, things are starting to finally make sense. Spot market volume won't improve much until that number here rises significantly. And as we see more volume, meaning more freight volume, that's when we can see spot market rates starting to make that increase. Current NTI, which is your National Transportation Index, National Truckload Index, excuse me, is at $2.27 a mile. Not much movement over the last 7 days. So if you've watched this last week, it's not much of a change. We're still about flat, right? Almost spot on to where we were last week. So it's not much of a change there. For some carriers, it's well below your profit level because there's some out here that are running at 230, 240 break even, and that NTI being at 227, meaning that if you're sticking around that, you're not going to be profitable. We saw a slight spike in June, as you can see on the charts at the very, very early June, but that softened out. There was nothing much behind that. So continue prioritizing. If you're on that contract in that regional freight side, if you're running blue to blue, continue to prioritize that because that's going to help you protect things. I would expect rates to kind of peak up a little bit around July 4th, but don't bank on something that's going to be any more sustained than that. Current diesel fuel prices is up. As you can see, man, look at that chart. Look at the right side of that chart, y'all. It's skyrocketed from 345 to 377 this month, which is crazy. Up 20 cents just this last week alone. It's the single sharpest increase in months. So it's major volatility around that side of it. I know we've had some dealings in the Middle East. Hopefully those dealings will subside a little bit. We'll start seeing that those global concerns kind of lay off. You as a small carrier, you're going to be much more vulnerable for fuel price swings, obviously, because that's your largest variable expense. So this is one of the things that I said, keep an eye on. We want to keep an eye on this going into the holiday weeks. I'm hoping that we don't see 402, 403 diesel fuel. But as of this trend that we're moving now, this is something that we're going to definitely want to continue to monitor very, very closely, because if tensions continue to escalate globally, I would certainly expect prices to exceed $4 a gallon and exceed that on average very, very quickly. Let's look at the spot rate change over the last 4 days. One of the comments that I got one of the users had readers had sent in was, man, things are starting to lighten up here on the blue side, which in the southeast, we run a lot of blue to blue out of the southeast. Remember, what you're seeing on your screen is an indication of actual spot rate changes. So if it's blue, it's good. If it's red, it's bad. It's simple as that. So you got your blue zones, which are rising rates. And we see those blue zones such in Southern California. You see that in the Northeast. You see the large portion of the Southeast, which is really, really good. See a large portion of the Southeast starting to see good rate activity. Meanwhile, you got some red zones. Take a look at your red zones, right? If you're going to head out to a red zone, just understand that when you get to those red zones or you get to that pink zone, it's not going to feel so good. So make sure that you're being very, very cautious on how you're doing it. This is the type of opportunity that if you're paying attention and you're operating from blue to blue, you're giving yourself a better chance to position yourself better, to have a better spot rate average, and you're going to have a better opportunity to getting that freight back in the area that you wanted to. Make sure that you leverage this map, just not for miles, but use it as your positioning strategy. So look at this map. Take a look at those areas, even pause this video if you need to, so that way you can strategize, take a screenshot, whatever you need to do. But these are your best opportunities in terms of finding those better spot opportunities, particularly during this particular time.
The super successful people are part of the 1%. They're part of that very, very small percentage. That's why I don't want you to do things that everybody's doing. I want you to do the small things that nobody else is doing. The people that are most successful in this business treat it like it's the only thing that's bringing income into their household. If you do that, then you'll have the same results. The people that I see most successful in this business operate like they have no other chance. They have nothing else going. This is the only breadwinner that they have in play. I'm Adam Wingfield, and this is the Freight Waste Playbook.
Now, another thing that I wanted to share in this week, I wanted to add in reefers this week because I got a reader that said, hey, we want to get a little bit more variations in there. So I'm going to add reefer in this week. Reefers, your outbound tender rejections is up to 11%, up 1.10% this week. Obviously, that's going to trend above dry van because temperature control is going to be a lot tighter around this time. We're seeing seasonal shifts because you obviously got your ice cream, produce, and meat. You're going to have that higher reefer demand heading into July. You should be feeling a little better in that. Well below peak season highs, but we're gradually coming out of that May lull. So if you look at April, you look at March, we're coming out of that lull and we're in a lot better position. Certainly not December of 2025 because reefers, y'all were eating good around that time, but you should start monitoring that because I think things are going to start moving, continue moving in a favorable direction for you. Your reefer truckload index, $2.53 a mile. It's down about 2 cents over the last week or so. They've dipped a little bit, and even though there are good ones out there, I don't see a continuous climb. So if you look over onto your map, you don't see that continuous climb. Certainly, you don't see December and February and January, but you don't see that continuous climb out, which is sustainable. Keep our eyes on that because if you look in comparison to July last year, we were hovering about 273, 274 on the average when it came down to reefers. We're about 20 cents below that. We're a long way off, but I still think that we're starting to show just marginal improvements as we go through it. So definitely wanted to add that into there. Now, I also want to talk about another change, which is your overall count in authority. So your carrier detailed net changes in trucking authorities. This is the difference between the amount of new authorities that come to the market versus authorities that exit. We saw last week that there was a decline last week. Well, here's another steeper decline. We're down 325 authorities. That means 325 net have removed themselves out of the marketplace. We're now seeing more carriers exit the market than entering the market. And that's usually a good sign when it comes to balance. Now, it's not a good sign, so don't take my words and try to misconstrue them. It's not a good sign for those folks that are wanting to maintain and stay in business. But when you talk about balance in an oversupplied marketplace, something does have to give. And in order for that to give, one or two things need to happen. Either we have to start buying a lot more stuff to where the demand starts increasing, or we have to get some of the cooks that are in the kitchen and have them do other things. So we're now starting to see more cooks exit the kitchen. This is one of the sharpest declines that we've seen in months. It could be because of ELP. It may not be because of ELP. It's something to kind of think about. A lot of folks are under the pressure, especially with fuel prices going up. We can expect to continuously to see those. So this can mean for you long term, if you're still maintaining where you're at, this is going to be less competition if you can hold on and run lean. Another thing I want to just kind of throw out here is the CAS index. It's a truckload volume index, truckload line haul index, excuse me. I wanted you to get just a little bit of more detail so that you can see what that is. This index tracks contract freight, right? So when you see a dip, it usually signals that there's a cut coming from your largest shippers. So this is one of those indexes that can kind of give you an insight as to what to expect on long term, or actually at least in the short term, midterm, let's say that, for spot market freight. So this is a good index. I wanted to just share it to you from a high level. So if it continues to trend downwards, obviously you can expect on a little bit of tightness there from your brokers that are out there, but make sure you're watching your all-in rate when it comes down to it versus your cost per mile. And don't misconstrue that. Make sure when you're doing that, you're considering what a fuel surcharge would be, even if they're not calculating fuel surcharge into it. But you got to know, you got to make sure your costs are covered. Make sure that your break-even point is covered. Understand that if you have a certain margin that you want to operate on for that year, you're going to win some, you're going to lose some, but on average, make sure that you stay within that margin that you want to operate on. What do I mean by that? Well, if your margin is, let's just say, hey, you want to make a 20% profit margin on the year, that means that if your break-even point's $2, that means you got to average 240 on all in on what you're averaging. So keep an eye on that. I just wanted to give you a little bit of that. Let's look at overall length of haul. We see length of haul up 3.71% this week, a little trending shorter. Average length of haul is certainly not where it was. If you go back to October and September, we're running about 640 miles. You see a lot more operators going to more regional opportunities, shorten that length of haul so that way they can showcase more profitable opportunities. You'll see that during these times. It does mean more handoffs. It does mean more tighter windows. It does mean more opportunities for detention. It does mean more docks that you've got to bump. But this does tell you that you typically, when you have those shorter length of haul, you're typically going to make a better profit margin in most cases. So this gives you the opportunity to kind of see where you're at in comparison to everyone. This is the chart that I wanted to show you that means that there's something that's brewing that could be beneficial to the small fleet here very soon. It's the Ocean Inbound TEU Volume Index. And right now, it's near the highest point it's been in almost 12 months. So look where we're at. Look where we're trending at. And what this chart measures, it measures container volume heading into the U.S. When you got a container coming into the U.S., that equals a truckload shipment, a truckload demand once it gets on shore. As you see, from mid-May to early June, you see where it was. It was right around 1,600, but now it's at 2177, almost 2,200. So these are the things that we could say that it could be meaning that more freight is sitting on the water right now, coming in around the holidays. It takes about 2 to 4 weeks for it to arrive. So that means that, hey, mid-July, we could be expecting to see some freight coming on shore and could definitely pick up that volume that we talked about earlier. So wanted to add on that little extra layer of information for you just to kind of watch out for. I love doing these things because it gives us the opportunity to really look at it from a different lens, especially from a small carrier perspective. Take this information and do with it what you need to because it's really important. So that wraps up this week's small carrier playbook market update. Remember, every load, every lane, every mile you run should be backed by real data and not guesswork. Use this info to plan smarter, position your truck better, protect your profits. The market's always shifting, but if you stay locked in, you can stay ahead. I'll be back next week with more insight and strategy, and we'll keep building this out together 1 week at a time. Until then, keep your head up, keep your numbers tight, and keep your wheels turning.